Hey everybody, so I just wanted to make a quick video to talk about the four basic financial statements that you'll see in this course. And I mean, there's lots of statements in accounting and lots of reports that we can create, but these are the four kind of fundamental or basic statements you'll see. So the first is an income statement, which summarizes the company's revenues and expenses over a period of time, usually a month or a quarter or a year. Second is a statement of owner's equity, which explains the changes in the equity from over a period of time. So, well, we'll look at them and I'll explain it more. Third is a balance sheet, which describes the company's financial position. That's what their words. It just means it's going to give us the balance of our assets, liabilities, and equity accounts at a given point in time. If you remember, the fundamental accounting equation is assets equal liabilities plus equity. So I always think of the balance sheet as a document that sort of summarizes where we stand as a company at one given moment in time as far as the balances of our assets, liabilities, and our equity. And then finally, a statement of cash flows, which will identify the cash that's come into the business and the cash that's gone out of the business over a period of time. So on the top, you'll see an income statement, a very simplified income statement, which is nice for our purposes right now. And you'll see that it has revenues, and this is the business earned consulting revenue and rental revenue. And then you'll see those totaled up. So for total revenues, that's the money the business made or the revenue they earned during that period. Remember, I mentioned in a previous video that not all revenue comes in cash. Sometimes we earn the revenue, but we're not going to get paid until later. And that will come up when we look at our statement of cash flows in a minute. And then the second section of the income statement right here are expenses. So expenses are the money we pay to operate. So we had a rent expense of $1,000 and a salaries expense of $700. And so then that would add up to our total expenses. So our revenue minus our expenses gives us something called net income. And net income means what it sounds like, the income that we earned during the period, or in other words, the revenue that we earned minus the expenses. And as I mentioned before, you'll notice the income statement is for this one's for a month, for the month ended December 31st, 2019. So this measures revenue minus expenses over a period of time. Second is our statement of owner's equity, which just summarizes our equity. And if you remember, the equity is the amount of the business that the business owners own. And what that really means is the assets of the business minus any debts or liabilities of the business. And remember, it comes either from the owners putting the money in or from the money the business earns. Minus any expenses and minus any withdrawals by the owner. So here's what a statement of owner's equity looks like. It has the beginning owner's equity, or what it was at the start of the period. So since this business just started, they started with zero. Then they have the investment by the owner. The owner put in $30,000. The net income that the business earned, you can see that's pulled right off of the income statement. So when you're making these, you need to make the income statement first, so that you have this net income number to put in right here. And so the business has zero to start, plus 30,000 investment, plus 4,400 in net income, minus withdrawals by the owner. The owner pulled out 200. And at the end, the capital or the statement of owner's equity will tell us at the end of the period, there was 34,200 in owner's equity. And so what I like about this is it sort of breaks it down for us. It says, okay, you had zero, now you have 34,200. Well, where did that come from? Well, 30,000 of it came from the investment by the owner. 4,400 came from net income, which was your revenue minus your expenses. And then minus 200, which went back out to the owner. So it just breaks it down for you. So here's our balance sheet. Now, unlike the income statement and the statement of owner's equity, the balance sheet doesn't measure change over a time or the amount of revenue and expenses we had over time. it measures the balance of these accounts at a given moment in time. So as of December 31st, 2019, there was 4,800 in cash, 9,600 in supplies, 26,000 in equipment, so total assets of 40,400. There was 6,200 in accounts payable, so our total liabilities, money we owe, and then equity, our total equity of 34,200. You can see that that equity amount comes right off of the statement of owner's equity. At the bottom of that, our total assets and our total liabilities have to balance. And when everything balances, is a wonderful feeling. All right, the last statement is our statement of cash flows. So we just put the balance sheet on here for reference, so you can see what information comes off the balance sheet onto the statement of cash flows. So it's broken into 3 sections: cash flows from operating activities. Operating activities is kind of just what it sounds like. What the business does day to day is its process of earning money. So we're going to have the operating activities are going to include cash received from our clients. You see that's different than revenue. In this case, it's the same as our revenue because we've received all the cash our clients owe us. But sometimes we could earn a certain amount of revenue, but not collect all of it yet. Okay, so here's our cash received from our clients minus cash paid for expenses. That's going to give us the net cash provided by operating activities. So we have $1,000 more at the end of December than we did at the beginning because of our operating activities. The second section is called cash flows from investing activities. Investing activities means when we purchase long-term assets such as equipment, land, and buildings that we're going to use over a long period of time for the business. We'll learn more about that later, but just know that that's what it means. So our investing activities involved cash paid for equipment. So we had a negative 26,000 in cash, or we would say cash used by the investing activities. And then the third section is cash flows from financing activities. Financing is anything we do to raise money outside of our normal operating. So that usually means borrowing money or receiving money through investments by the owner. Or it could also mean negatives could be paying money out to the owner or paying off that debt. So here we can see this business had cash investments by the owner minus cash withdrawals, gave us net cash provided by the financing activities of 29,800. So here's an interesting thing, because I mentioned borrowing. So when a supplier allows us to not pay for our supplies until later, we don't typically include that. We don't ever include that in financing activities. We consider that part of the operating activities. So this is just like long-term loans from a bank or investments by the owner that happens down here in financing. So then we can see we had 1,000 provided by operating, 26,000 paid out through investing, 29,800 provided by financing. So the total of those three gives us our net increase to cash. And then we'll see that we had a 0 balance on December 1st and a $4,800 balance on December 31st. And that should match up with our asset cash here on the balance sheet. And so that's how they all flow together. So again, the net income flows to the statement of owner's equity, helps us calculate our total owner's equity. That will flow to the balance sheet in the equity section. And then our cash from our balance sheet will flow to should match our cash balance on our statement of cash flows. So hopefully you feel a little more comfortable. It's still scary because it's new, but I'm telling you, just like anything else, like when someone's trying to teach you a new game and they try to explain it to you and it seems all complicated, after you play a few hands, it's not so bad. So it'll be the same way here. As you continue to work with these statements, they'll make a lot more sense and you'll get a lot more comfortable with them.